APRA's warning to the banks. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from Mortgage Business discussing APRA's warnings to the banks. You know APRA, the organisation that monitors and ensures the banks are all doing everything ridgy-dig, and also requiring buffers for calculating loan repayment requirements, so people are trapped in mortgages that are more expensive than cheaper options that are around. But you know that's just part of the sacrifice we're willing to make to ensure the stability of the system. Isn't it awesome, guys? You know that's the Australian way, caring about the banks. Well, in all honesty, people would rather have nice, boring stability and security than freedom and flexibility. But anyway, so APRA warns banks about overusing lending exceptions. The prudential regulator has warned banks that lenders with high volumes of lending exceptions will be faced with heightened supervisory attention. Oh boy. The chair of the Australian Prudential Regulation Authority, John Lonsdale, has written to banks to remind them of the regulator's expectations when it comes to managing exceptions to housing lending policy, and warned them that any bank reporting large volumes of policy exceptions will be subject to heightened supervisory attention. In a letter to regulated authorised deposit-taking institutions, the APRA chair noted that some banks have recently announced changes to their exception processes to support borrowers experiencing serviceability challenges. Okay, remember, it's not about the people, it's about keeping the system operating. And this is why when people draw analogies to the GFC and the collapse that happened in the US with their housing market, it's not going to happen to the same extent as here in Australia. For example, this may include borrowers who are rolling off super low fixed rates onto interest rates that are around 3 times higher, and who may now be subject to the higher 3 percentage point buffer, previously 2.5%. Added to this are higher cost of living pressures, which, when combined with higher rates and serviceability tests, may be creating mortgage prisoners who are unable to refinance. Given these constraints, several lenders, including Westpac and its subsidiaries Bank of Melbourne, St George Bank and Bank SA. Notice how all these banks are the same bank. So, you know, the 250 grand government guarantee, if you got 250 in Westpac, 250 in Melbourne, 250 in St George and 250 in Bank SA, and they all happen to collapse and you think, oh, it's okay, I'll get the insurance for each one of those banks. It's only one. You only get one slice of the pie. It's why you need to keep it in separate organizations or deposit or ADIs. Anyway, they began tweaking their serviceability tests. Yeah, this is a good thing. You don't want people being mortgage prisoners, because I remember when I was consolidating some loans. So we had a mortgage on one property and on our main residence here, which skyrocketed in value because it's Australia and property's stupid. So I had a lot of equity. So I thought, okay, we'll take that loan, we'll get it on this house, get easy. It'll be easier for us to afford, easier for us to manage. We'll have to pay less. And the bank was going through it all, and the rep from the bank couldn't quite figure it out. And I'm going, this is going to be cheaper and easier for me to manage. Why can't you do it? The LVR is crazy. And because that was the challenge of me being a small business owner, so they had to get someone with a little bit more capability to do it, not just tick a form. All worked out in the end. But could you imagine there are people here that could be getting a better deal, that could be paying, lower interest on their loans, but because of these rules, they may not be able to. How's that fair? And it's probably even, it could even be a subby that was working for Porter Davis that isn't going to get a cent, but CommBank will get all their money first. Oh, boy. Boy, oh, boy. It almost makes you wonder why you want to do your own thing and not just become an employee for one of the big banks, eh? While applications to refinance an existing customer mortgage will continue to be assessed under standard serviceability criteria and document verification requirements, Westpac has said that if certain customers are unable to meet serviceability under the standard assessment criteria, a modified serviceability assessment rate may be applied. This rate would be applied as a credit exception to new and existing customer mortgage commitments. However, the bureaucrats can't let this happen, can they? APRA has warned banks about the frequency with which it applies these exceptions. Regulators reiterated that banks must apply a 3% minimum serviceability buffer above the housing loan interest rate when assessing borrowing capacity, stating this provides a contingency for rises in interest rates over the life of the loan, as well as any unforeseen changes to a borrower's income or expenses. Yeah, and now we're seeing that happen. Interest rates have gone up by 400 points in months. Isn't that what the buffers are for? Well, yeah. It's all fun and games, isn't it? With the potential for interest rates to rise further, inflation still high, and the possibility of weaker labour market outcomes, the buffer is an important risk mitigant, the chair said in his letter to banks. He added that while APRA's prudential framework enabled banks to use exceptions to policies to approve a loan that does not meet standard loan criteria, such as reduced serviceability buffers or additional indicators of repayment capacity, these should be managed prudentially and limited. The letter read, APRA requires banks to have prudent policies and processes for dealing with exceptions to policy. Large volumes of exceptions can create risk by weakening banks' risk profiles and increasing the vulnerability of their loan books to future shocks. Historically, serviceability policy exceptions have accounted for a small share of banks' total housing lending, between 2 and 3%. It is important that exceptions are used in a prudent and limited manner, so as not to undermine the intent of the core policy in using exceptions. APRA expects banks to make a prudent assessment of repayment capacity so that there is a good outcome for borrowers and the financial system. Prudent banks would have acceptable reasons and clear justifications for loans written outside policy, flagging that banks should also consider their responsible lending obligations. Loans written as exceptions must be regularly reported to the relevant internal governance bodies of the bank and monitored against risk appetite limits. Notice the thing here, all the talk about risk and managing risk, that's what banks are in the business of. Risk management. Prudent boards would assess the impact of any proposed changes to exception processes on the bank's risk profile and risk appetite. This includes understanding the type of loans that are being written outside policy, such as like-for-like refinancing. In conclusion, the prudential regulator requested that banks notify their supervisor ahead of material changes to their exceptions process. APRA will be monitoring exceptions trends closely and may require additional information to assess how banks are managing risk. Banks reporting large volume of policy exceptions will be subject to heightened supervisory attention, with some lenders having announced that they will apply reduced serviceability. In some instances, other banks have been hesitant to do so. Indeed, AMP's bank's head of credit, Shane Scott, recently said that non-major banks would be sticking with a 3% buffer on its loans, as it considers it to be very risky to ignore APRA's serviceability expectations. Our position at the moment is it would be very risky to ignore APRA's mandated 3% buffer, he said during a credit webinar earlier this month. So we're sticking with 3% at the moment, but are looking at other concessions that we can make in terms of assessment of income, loan terms, etc., to help those customers who are facing difficulty in repayments because significant rise in interest rates we've seen in the last 12 months. Well, let's talk about this one, guys. This shows you it's the Australian approach to things. It's some people will be thrown under the bus, will have to pay more interest because for the greater good, they want to maintain the safety and stability of the system. That's what's going to happen, and that's what the majority will advocate for. Sure, there'll be people moaning on a current affair and complaining, and I'm frustrated that you're going to have people stuck in higher mortgages than otherwise would be. But that's the Australian way, guys. What do you reckon? Are you surprised? Check out HeiseBim or Heise Does. Thanks for watching. If you're a fan and want to support us, you can on YouTube or Patreon. Use our referral links, buy our pocket squares, or call me if you need an architect. Take care. Have a great day. I'll see you next time. Bye for now.